Hello, I'm Dan Beniak. I'm a Municipal Portfolio Manager here at Treasury Partners. We're shooting this quick video to give our clients an update on an opportunity that we're seeing rapidly form in the municipal bond market. Specifically, over the past few weeks, we've seen rates spike across all fixed income markets due to changing investor perceptions about future conditions in the economy and inflation. But the rate spike has been harder and faster in municipals than it has been in other sectors. There's a few different reasons for that, but importantly, they're not fundamental reasons, which is to say we don't think investors think that municipal credit fundamentals are deteriorating and are selling their holdings accordingly. Rather, they're for what we would call technical reasons or a relatively temporary imbalance between buyers and sellers leading to a pressured market. On the buyer side, typically April is a relatively low support buyer month compared to other months throughout the year. It's tax time. We've seen in past years that buyers historically tend to turn to their municipal bond portfolios as a source of money with which they could raise cash to pay their tax bills. But also we have fewer natural maturities leading to lower reinvestment pressure. So buyers haven't been snapping up attractive yields as much as you would think they would this time of year. Whereas on the seller side, we've seen tens of billions of dollars coming to market in terms of new bonds being issued every year, every week by issuers who need to finance their public infrastructure projects and fund their capital plans and need to keep coming to market. So when you have lots of bonds coming to market, less buying interest than usual because of unusual reasons colliding, you get the natural consequence of spiking rates in munis that we don't think is going to last particularly long because there's no fundamental reason for it, is to cause it to persist for much longer. The result of this is that we're seeing some absolute levels in rates that we have only seen for very short windows over the past 15 years or since the great financial crisis. Rates are volatile and changing by tens of basis points seemingly by the day, but as I'm shooting this video, I can go out and buy good quality, long-term municipal bonds with good structure and high coupons for 4.5% plus yield to call, which is 6 to 9% after tax, depending on your state and your tax situation. A great return by our estimate. We're taking advantage of this opportunity as best as we can for all client portfolios that can actually take advantage of this. We're deploying liquidity aggressively in terms of any taxable bonds, such as corporates or short-term T-bills in accounts. We're looking to see if we can sell out of those bonds to rotate out of them, raise proceeds to buy municipals at these elevated rates and lock them in for the long term. It's an exciting time. We're working hard. If you have any questions about how this affects you and your portfolio, please feel free to reach out to us and talk to your advisor. We're happy to help. Thank you.